Economic headlines often stir public concern. Talk of a potential recession fills the airwaves. People start to worry about their jobs. They also think about their savings. Understanding economic cycles becomes very important. It helps us prepare for what might come. Knowledge can reduce fear significantly. This essay will explore these ideas. We want to see what history can teach us. Looking back helps us look forward. Economic cycles are a natural part of market economies. They involve periods of growth and periods of contraction. No economy grows in a straight line forever. These ups and downs are often called business cycles. Recognizing the phase of a cycle is crucial. It informs policymakers and individuals alike. Are we near a peak or approaching a trough? This question is always on economists' minds. We seek to understand the rhythm of the economy. This understanding is key to navigating its shifts. What exactly is a recession? Many people have a simple definition. They might say it is when the economy shrinks. Often you hear of 2 consecutive quarters of declining GDP. Gross domestic product, or GDP, measures economic output. This is a common rule of thumb. It is widely used in media reports. However, this definition is not the official one. The official arbiter in the United States is different. It is the National Bureau of Economic Research, or NBER. The NBER has a more comprehensive definition. It defines a recession more broadly. It is a significant decline in economic activity. This decline must be spread across the economy. It must also last more than a few months. The NBER looks at various indicators. These include real GDP, of course, but also employment and real income. Industrial production is another key factor. Wholesale retail sales are also considered. The United States has experienced many recessions. They are a recurring feature of its economic history. Since the early 20th century, there have been numerous downturns. The NBER has officially dated these periods. Understanding their frequency can be insightful. It reminds us that economic contractions are not rare. They are part of the long-term economic landscape. Some recessions were short and relatively mild. Others were long and severe, with lasting impacts. Each one offers lessons for today. On average, U.S. recessions have varied in length. Some lasted only a few months. For example, the recession in early 1980 lasted 6 months. Others extended for more than a year. The Great Recession, from December 2007 to June 2009, lasted 18 months. This was the longest since World War II. The duration significantly impacts the recovery process. Longer recessions tend to cause more economic pain. They lead to higher unemployment for longer periods and deeper impacts on businesses and households. One of the most talked about recession indicators is the yield curve, specifically an inverted yield curve. What does this mean in simple terms? A yield curve plots the interest rates of bonds. These bonds have different maturity dates. Typically, longer-term bonds have higher yields. This is because investors demand more compensation. They are compensated for tying up money longer and for taking on more risk over time. So, a normal yield curve slopes upward. An inverted yield curve is when this pattern flips. Short-term treasury bonds start to offer higher yields, higher than long-term treasury bonds. For instance, a 2-year treasury note might yield more than a 10-year treasury bond. This is an unusual situation. It often signals that investors are worried. They expect economic growth to slow down. They also anticipate that interest rates will fall in the future. So they rush to lock in current long-term rates, even if those rates are lower than short-term ones. Beyond the curve, other vital economic thermometers. While the yield curve is a prominent signal, it is not alone. There are several other indicators that economists and analysts keep a close eye on to gauge the health of the economy. Economists monitor a dashboard of indicators, each providing unique insights into different aspects of economic performance. These indicators help to paint a fuller picture of the economic landscape, offering a more comprehensive view than any single metric could. One key area is the labor market, which provides critical information about employment trends and workforce dynamics. Rising unemployment claims are a classic warning sign of economic distress, often preceding broader economic downturns. A slowdown in job creation is also concerning, as it may indicate that businesses are becoming more cautious. If businesses stop hiring or start laying off workers, it indicates weakening demand and activity, which can ripple through the economy. The monthly jobs report is therefore watched very closely by economists, policymakers, and investors alike. It provides timely data on employment trends, helping to inform decisions and forecasts. Consumer confidence is another critical indicator, reflecting how optimistic or pessimistic people feel about the economy. Consumer spending accounts for a large part of economic activity, driving demand for goods and services. If consumers feel pessimistic about the future, they are likely to cut back on spending, especially on big-ticket items like cars or appliances, which can slow economic growth. Surveys measuring consumer sentiment can provide early warnings of shifts in spending behavior. A sharp drop in confidence can foreshadow a slowdown in economic activity, signaling potential trouble ahead. Business sentiment is equally important, as it reflects the outlook of companies on future economic conditions. Indexes like the Purchasing Managers' Index or PMI are key indicators of business sentiment and economic health. They measure the health of manufacturing and services sectors, providing insights into production levels, new orders, and overall business activity. The psychology of slumps behavior and economic forecasts. Economic models often assume rational actors. However, human psychology plays a significant role. Behavioral economics studies this intersection. Fear and optimism can be powerful economic forces. During periods of growth, optimism can fuel investment. This can sometimes lead to speculative bubbles. People might believe that good times will last forever. This is what I have called irrational exuberance. Such sentiment can push asset prices to unsustainable levels. A correction often follows eventually. Conversely, fear can accelerate a downturn. When recession talk begins, fear can spread. Consumers might delay purchases due to uncertainty. Businesses might postpone investments or hiring. This collective pullback in spending can become self-fulfilling. It can turn a mild slowdown into a deeper recession. Animal spirits, a term coined by John Maynard Keynes, describes this. It refers to the instincts and emotions that guide human behavior. These spirits can shift dramatically. They can influence economic outcomes significantly. The current climate. Reading the economic signs in May 2025. As of May 2025, the economic picture presents complexities. The landscape is filled with mixed signals that require careful interpretation. We must look at current data through our historical lens. Understanding past trends helps us make sense of present conditions. Let's consider the yield curve first. This financial indicator often provides insights into future economic activity. Suppose, for our discussion, the yield curve has been flat. This could indicate uncertainty in the market. Or perhaps it showed some brief mild inversions recently. These inversions can be early warning signs of economic downturns. This would suggest some market concern about future growth. Investors might be wary of potential risks ahead, but perhaps not an immediate deep alarm. The market's reaction can vary based on other factors. The degree and duration of inversion matter greatly. A short-term inversion might not be as concerning as a prolonged one. A deeply inverted curve for many months is a stronger signal. It often precedes more significant economic challenges. We would need to analyze its current specific shape. The nuances of the curve can tell us a lot about market expectations. Next, let's examine the labor market. Employment trends are crucial for understanding economic health. Imagine unemployment remains relatively low. This is generally a positive sign for the economy. However, job growth might have slowed from previous robust rates. This could indicate a cooling off in economic activity. Perhaps initial jobless claims have ticked up slightly. This might be an early indicator of trouble in the job market. These could be early signs of softening. It's important to monitor these trends closely, but not necessarily a full-blown crisis yet. Mixed signals require a balanced and nuanced interpretation. It is important to watch trends, not just single data points. Long-term patterns provide a clearer picture of economic health. A consistent rise in unemployment over several months would be a more significant cause for concern. This could signal deeper issues in the economy. The labor market often lags other indicators. Changes here can confirm trends seen elsewhere. Consumer confidence and spending data are also key. These metrics reflect how the public feels about the economy and their willingness to spend. Global winds. How international factors shape our outlook. The U.S. economy does not operate in a vacuum. It is deeply interconnected with the global economy. Events in other countries can have significant impacts here. A major slowdown in Europe or Asia, for example, can reduce demand for U.S. exports. This can hurt American businesses and employment. Global supply chains are also crucial. Disruptions, whether from geopolitical events or natural disasters, can affect prices and availability of goods in the U.S. These can contribute to inflationary pressures or slow production. International financial markets are also linked. A financial crisis in one major economy can spread quickly to others through capital flows. Changes in global investor sentiment can affect U.S. markets. Currency exchange rates play a role too. A strong dollar can make U.S. exports more expensive. This can reduce their competitiveness abroad. Conversely, a weaker dollar can boost exports, but it might also increase the cost of imports. These dynamics are complex and ever-changing. Battening down the hatches, safeguarding your personal finances. If a recession seems possible, what can individuals do to protect themselves financially? Preparing personal finances is a prudent step that everyone should consider. It can significantly reduce stress and provide a much-needed safety net during tough times. The first priority is often establishing an emergency fund. This is savings set aside specifically for unexpected events and emergencies, like a sudden job loss or an unexpected medical expense. Financial advisors typically recommend saving 3 to 6 months of living expenses. This fund should be kept in a safe, easily accessible account for quick access. Having this financial cushion can prevent you from going into debt during emergencies. It provides peace of mind and stability during uncertain times. Managing debt is another crucial area to focus on. High-interest debt, like credit card balances, can be a significant burden, especially if your income decreases during a recession. Developing a plan to pay down such debt is a wise move. This might involve prioritizing debts with the highest interest rates first, or consolidating multiple debts into a single lower-interest loan. Reducing debt obligations frees up cash flow for other essential needs. It also improves your overall financial resilience. Avoid taking on new unnecessary debt if a downturn looms on the horizon. This is a time for financial caution and careful planning. Navigating the inevitable economic seasons. Economic cycles, with their expansions and recessions, are inherent. They are a natural feature of market economies. Just as nature has its seasons, so does the economy. Periods of growth are like economic summers. Recessions are akin to economic winters. Understanding this cyclical nature is fundamental. It helps us avoid surprise and panic. It allows for more rational responses from policymakers, businesses, and individuals. History teaches us that these cycles persist. Predicting the exact timing of a recession is notoriously difficult. Many economists have tried with mixed success. Indicators like the inverted yield curve offer clues. So do employment data and consumer sentiment. But no single indicator is foolproof. A holistic view of many factors is necessary. Even then, uncertainty always remains. The economy is a complex, dynamic system, influenced by countless decisions and events, including human psychology and global factors.